Uh, Thank you all for joining this online session on the implementation of Pillar 2. Would like to start by thanking ABDF and the organizers for putting together this stellar team to talk about the topic. It is a very timely topic since the OECD just released a huge amount of guidance on it. It has political implications, of course, and it has a lot of technical implications. We will not be really talking about the political implications of Pillar 2 and the whole approach. There will be a panel separately dealing with that issue. As you know, there are some discussions going on at political levels about who should be actually leading this work, whether this is the right way to go or not. There is a report that was just issued by the Secretary General of the United Nations. There is another initiative at the level of Latin American and Caribbean Ministers of Finance. It's not going to be our focus. We probably cannot avoid it all the time, but we are going to actually consider that the train has left the station, that Pillar 2 is coming, and we will discuss the implementation of Pillar 2 in various regions of the world. I'm happy to have with me a great team who could talk to you about these issues. I will introduce them when they would make their presentations. But just to sum up, we have with us Professor Miranda Stewart from Australia. We have John Peterson from the OECD. We have Alvaro Villegas covering Latin America from Bolivia, and Leidson Rangel from your own Receita Federal. All right. Now, this Pillar 2 is basically in a nutshell. It provides for a minimum effective tax rate on global operations of large companies, those with revenues in excess of 750 million euro, of 15%. I will not go into the detail. John Peterson will describe that very well to you in a minute. But in a nutshell, there are three different and complementary ways of doing this. One is what we call the IIR, income inclusion rule, and that is that the ultimate parent company in its own country of residence makes sure that all its constituent entities all over the world would have that minimum 15%. And if they are below that minimum 15% ETR, that it would pay a top-up tax to its own country of residence. Then there is the UTPR, and that is basically when the country of residence does not have an IIR, that other countries would actually levy the top-up tax, right? And then we have the QDMTT. Basically, the QDMTT would allow countries themselves to impose a qualified minimum tax of 15% so that other countries do not pick up their own tax, right? Then there is a cousin, I don't know if I should call him a cousin or stepbrother, and that is the STTR and the subject to tax rule. And that would allow the source countries actually to sort of, it's like a switchover clause, allowing source countries to levy an additional tax so that the total tax on specified payments, we call them covered payments, would be at least 9%. That is the tax levied by the source country and the tax levied by the country of residence. So with this, actually very, very happy to have John Peterson with us. John is in charge of the division dealing with these, with Pillar 2 at the OECD. I'm not sure I can call you the father of Pillar 2, but you're definitely the midwife. Would that be a good description?
Yeah, I've certainly been there since the gestation. That's probably the best that I can say, Dali.
All right, great. So thank you for being with us, John. I know it's very late for you, and this occasion also thank Miranda to being with us because it's very, very early for her in Australia. Now, you've come up with I think 600 pages or something, like 3 weeks ago. And I'll tell you, I don't have a lot of hair, but whenever I hear, okay, OECD releasing something, I start pulling my hair. And I'm really in a good position because all I have to do basically is just sit down and read. But you have to write the stuff. How does your day look like?
What does my day look like? Well, I spend some parts of my day in meetings with Leidson here as we work our way through various issues that have arisen in relation to Pillar 2. But no, look, a big part of the work that we have been doing up until now is really putting in place key pieces of guidance that are needed really in order to put countries in the position where they can start to implement the globe rules. We had a set of rules that we developed, well, guess almost a couple of years ago now, the model rules, and then the commentary that followed. But those rules were sort of the basic infrastructure, and as countries went to sort of think about the challenges that they had with implementation, they looked at particular issues and came back to us looking for specific guidance, precisely so they could go ahead and legislate. And it's our expectation, in fact, that with this latest set of guidance, which pulls together some important issues regarding, you know, the treatment of tax credits, also in relation to substance-based exclusion, but significantly in relation to the QD and TT, that we now have a complete set of guidance that will allow countries to go ahead and legislate.
All right, great. Now, let me tell you this, John. There is this political discussion going on about the whole thing, etc. And myself, I do have conceptually, I do have doubts about it, but it's not because you're here. I mean, technically, you cannot fault it, what has been so far. So congratulations on that. And with this, now the baby. How does it look like? What is it?
Perhaps that's the right time for me to sort of, if I can
please,
pull up the slides that we have for this presentation. You have to excuse me. I'm on holiday in France with my family, and as you can tell, they're turning off the lights and going to bed here. So you have me dressed somewhat informally, I'm afraid, and you will see half-naked children wandering around in the background as something of a distraction. But if we can pull up the slides in relation to this, and I can just talk very briefly through these rules and how they work. As you said, there's two elements to this set of rules. We're familiar, I guess, with the globe rules.
Can we pull up the slide for John Peterson, please?
Or maybe even I can share my own slide deck if that is easier. I don't know. There we go. So if we go to the next slide here. And what will come up is two key elements here of Pillar 2. The first is the globe rules, which I think we're familiar with. These are, of course, a set of model rules that are intended to be implemented into domestic law. They're based on a common approach, which is to say that countries are certainly not required to introduce these rules. But if they do want to introduce them, they commit to do so in a consistent way, and they accept the application of the rules by other countries. They're based, as we know, on a jurisdictional effective tax rate test that tests the net income in each jurisdiction and the effective tax rate on that income, and imposes a top-up tax on that income if it is below the 15% rate. And these rules are broadly limited to M&E groups that have revenues of 750 million or above, which is consistent with rules that we have for country by country reporting. Now, just, very briefly, because I don't want to dwell on this much further, but it's important to remember, and it came out as part of the July package, also work that's been done in the area of the subject to tax rule. This was a rule that was considered very important, particularly for a number of developing countries that considered that they had high rates of taxation in their jurisdiction and that they were exposed under their treaties, particularly in regards to service payments and the risk that these could be used for base erosion and profit shifting. And what this is a treaty provision. It's a change to an existing bilateral tax treaty that can be requested by any developing country. And if it is requested, then the IF is committed that then this provision will be introduced in circumstances where the provisions could potentially apply. And what it does is it looks to the nominal rate of tax on various types of payments. So it looks at these things on a transactional basis and tests them to see whether they are subject to a 9% nominal rate in the residence jurisdiction. Now those, the STTR, unlike the globe rules, which apply to the net income of all the entities in the group, these are rules that only apply to on a payment basis. They only apply to intra-group payments, and there's certain exclusions that apply, and particularly in relation to payments that generate a low return. So those are the two key elements of Globe, and we're very pleased to have been now in a position to finalise the work on the STTR and now move through to implementing that aspect of Pillar 2 as well. If we can move to the next slide. Which is just touching on where we are currently in terms of the work that we're doing to support the implementation of these rules. Obviously, we have the model rules themselves, which provide a template for countries that are looking to implement the Globe rules, but provide a common template, so one that is intended to be the basis for each country's introduction of these rules. And I believe, as Miranda may be touching on later, there are a number of different ways in which countries have gone about deciding to apply and bring these rules into effect. It can include translating the rules directly into your domestic law, or doing so by cross-reference. Further to that, we've provided the commentary, as you're aware, Dali, that in the 600 pages that you are referring to. I don't know if it's quite that many this time around, but it's I think there's a fair chunk of guidance that has come out in recent days. And that commentary and guidance is intended to provide both technical guidance, further clarification on the rules, but also, as I say, in these initial phases of implementation, it was intended to clarify the operation of certain parts of the rules in order to make them fit for implementation. We then have...
John, can I just interrupt you for a minute?
You can.
There definitely won't be a need for, at least in your view, and I think that's actually the official position, but just to confirm, for a multilateral instrument for the Globe rules, at least for UTPR.
That's correct, because the idea behind the Globe rules is in practice that they are implemented into each country's domestic laws, and they're done so in a consistent and coordinated way. So they applied a common tax base, a common method for calculating covered taxes, and an agreed rule order for the allocation of any top-up taxes that could arise in a jurisdiction. And I think you touched on that before, Dali. I guess we would say that sort of the way in which these rules apply is if there is less than a 15% tax imposed on local domestic income as calculated under the Globe rules, then the initial ability to impose that tax is through the imposition of a qualified domestic minimum top-up tax in the jurisdiction jurisdiction. If that doesn't exist, then there are rules under the income inclusion rule that allow that to be picked up under another country's rules, but again, domestic rules. And then failing that, there is the undertax payment rule that allocates that top-up tax amongst all the entities in the M&E group that are resident in jurisdictions that have the UTPR. So this is all based on domestic implementation and sort of synchronized and consistent implementation. That's correct. Further to that,
the peer review would actually work as a corrective mechanism.
That's right. So you can see in the slide deck here, I have a reference to the peer review process, and the peer review process therefore plays a very important role here in ensuring that we have a consistent set of coordinated rules. And one of the big tasks that we now need to confront in the second half of this year is start the peer review process with countries as they begin to implement these rules and bring the work back to WP11 to explain what they've done and to ensure that we have a consistent and coordinated rule set. That's correct. The other things that we're doing to support implementation is we recently released a draft of the Globe Information Return, which is intended to be a common return that provides for, again, a standardized set of data points based on the tax calculation rules that we have developed. And we are now working on the design of information exchange framework that's intended to simplify the administration and aspects of these rules and protect the confidentiality of information by having sort of a common filing practice and exchange network, similar to the type of framework that we have under CBCR. Further to that, and in parallel with that, we are now looking at putting in place an administrative framework.
Sorry, John. So that's the Global Information Return. There should be also something else for the STTR, right?
That's yeah. So for the STTR, it's a different exercise. It requires effectively, I guess, countries would need to legislate whatever rules they wanted to domestically to impose source taxation, and then the STTR would operate potentially through some kind of multilateral instruments to amend bilateral treaty arrangements as necessary. That's right. Yeah. Finally, I guess on the slide, there's a reference to the administrative framework, which would also, have focus on ensuring we have not just, consistent and coordinated rules, but also that they are being applied in a consistent and coordinated way. There's much that we can do there, both in the dispute prevention context as well as the dispute resolution context. Perhaps slightly less of a priority for us, given the fact that that type of administrative framework doesn't necessarily need to be in place in the initial phases of these rules as they begin to apply, but is very much an important part of the overall infrastructure that we would intend to provide here. I'll go on to the next slide because I don't want to chew up too much of anyone else's time. So if I just go through to the next slide and just talk a little bit about how the rules are designed themselves. This is I guess a simplified diagram that explains the effective tax rate calculation and how the computation mechanics work. And broadly, you start with globe income, which is the green set of words there on the screen. And globe income, the starting point for calculating globe income is in fact the financial accounts of the relevant M&E. Adjusted primarily for those types of adjustments that we typically see in local tax laws that are designed to remove what are often significant material permanent differences between the tax base and the financial accounting tax base. And that becomes the basis for the tax base, and the selection of the financial accounting standard that is used is determined under the Globe rules by reference to the standard used in the preparation of the consolidated financial accounts of the UPE. What then happens is you then need to calculate the covered taxes, and this is done essentially again using the accounts. It's using the tax expense that are in the financial accounts themselves, which incorporates deferred tax items, movements in deferred tax items, deferred tax assets, and liabilities. And by doing that, we give ourselves the ability to smooth over timing differences that can arise between differences in timing that can arise between local tax and financial accounting, as well as providing a mechanism for recognizing relief associated with losses that are provided in each jurisdiction. So that ETR calculation then throws up a jurisdictional ETR, and so those amounts are both calculated at the jurisdictional level, and we use mechanisms that are similar to those used that we have used in CBCR and CBCR reporting to identify which income belongs to which jurisdiction. Once you've got a jurisdictional ETR calculation, you then also need to work out, this is the globe rules apply only to excess profit. There is a substance carve out that applies in the context of the globe rules. So you take the globe income and you apply a substance carve out, which is calculated by reference to assets in that jurisdiction or employees in that jurisdiction. So there's a certain percentage of assets and employees are excluded from the income calculation to determine the excess profit. And that excess profit is then multiplied by the difference between the min rate of 15% and the jurisdictional ETR, effectively the amount of top-up tax that needs to be imposed on that excess profit. And that then gives you a jurisdictional top-up tax figure. With the final qualification, you can see on the bottom line here that there is a deduction or a credit, effectively a full credit for the imposition of any qualified domestic minimum top-up tax. So it brings me back to the point that I was making earlier in my presentation, Dali, that really it's the QDMTT here in the rule set that applies first in this situation, and that's because it is available as a direct credit against any top-up tax liability that would otherwise arise under the globe rules. And I hand it back to you, or the next speaker, Dali, to see if there's any further comments on that. But happy to take
Thank you very much. Thanks. I'll just continue a little bit on the implementation from my side quickly. I was thinking about maybe saying a couple of words about the CTR, but you already mentioned that, and I think Alvaro probably will mention something about it. So I'll skip that just for the to save time. And I'll talk a little bit about the Europe because I'm the only actually participant, I think, from there. So in Europe, actually, we have started with the implementation through a directive. Within the European Union, there are two types of legal instruments. Either directives, there is also a convention at one point, but mainly it is either a directive or a regulation. A regulation is something that applies directly in the laws of the member states. You don't have to transpose it into your domestic law. And a directive normally requires transposition into your domestic law, unless, of course, the domestic law is compliant, right? Then you don't need to do anything. And so in Europe, they opted for a directive. Why? Actually, to avoid, because some aspects of the global minimum tax might conflict with EU law. And so in order to protect against that, they opted for a directive, right? This directive needs to be transposed by the end of the year, all right? The directive, just like the global minimum tax rules, the standard OECD rules, it provides for an IIR, for an income inclusion rule, an EU TPR, but also there is an option for QDMTT. There are two main differences from the European Union approach, from the OECD standard approach. And that is that within the European Union approach, within this directive, actually, purely domestic situations are also covered, right? It's not only low taxed foreign entities. Also purely domestic is covered. Why? Because to eliminate any discrimination, and so to eliminate actually conflicts with EU law, all right? And the Second thing within the directive, in Dutch we call that cattle trading. I think in English it's called horse trading, as a result of some kind of horse trading. Because actually, within the European Union, we have the countries that are most adamantly in favor of Pillar 2, and those countries that are adamantly against Pillar 2. And so they had to reach a compromise. And the result of this compromise, there is an opt-out for EU member states to implement the directive. And that is on the condition that they have, I believe, they have less than 12 ultimate parent entities. And that is like for reason of administrability. You know, if you don't have, I mean, some countries don't have really a lot of ultimate parent entities, and then they would think, okay, a lot of work, maybe, okay, let's opt out. And that opt-out would apply until the end of 2029. So from 2030, it phases out, all right? Now, on the implementation side, there are a lot of countries that have started releasing drafts. I mean, many countries, which is quite a nice development I have seen. I haven't seen it a lot in the past. Many countries are releasing consultation drafts. And some of them even like multiple consultation drafts, right? I think the latest released was that of Luxembourg. There are some major countries that have not started. They've started, but they have not released anything yet. I think, if I'm not mistaken, John, the major one is France and Italy. They have not released anything yet. Germany did release something. Interestingly, for Germany, and I think we will touch on this later, is that what they did is that they said they're considering removing their CFC legislation because in their view, the global minimum tax rules would make the CFC rules like not really needed, all right? Outside the EU, there is the UK as well. The UK actually have adopted legislation for the global minimum tax, but only, I believe, with an IIR and a QD-MTT. But they said that they are also thinking about the possibility of having a QD-MTT. The absolute latest development we have in the EU on the implementation of GMT, of global minimum tax, is a decision by the European Court of Justice, the General Court, which dismissed a claim by a Dutch company to invalidate the directive. All right. Unfortunately, the decision, I think, was taken like late July, was released this weekend, I think either Friday or Monday. Unfortunately, the dismissal was based on procedural grounds. There is a window actually to file an invalidation claim against the directive, and that window closed on 15 March last, and the company filed the invalidation claim on 16 March, which reminds our lawyers that law is also procedures. It's not just technical legalities. All right. Now, there is still one claim for invalidation of the directive, again by another Dutch company, one which is active in Brazil as well. I'm not sure, actually, I doubt that would have, even if it is admitted, even if it is accepted, I don't think it would have really any impact because it is targeted at very specific aspects of the GMT. This is a shipping company, Fugro, and the claim is based on the interaction between the directive and like the tonnage tax regime and other shipping regimes, which are actually permitted under EU law. All right. So with this, I think we've covered like Europe, and when you think about GMT, actually, in my imagination, I think about an elephant in the room and some sleeping giants. Now, the elephant of the room, everybody knows who it is. Shall we mention it? The United States. That's the elephant in the room. But we're not going to deal with the elephant. We're going to deal with the sleeping giants. Now, the problem with sleeping giants is that sometimes they're not really sleeping. They give you the impression that they are sleeping and they're not sleeping. I think Miranda will address two of them, India and China at one point. And I'm happy to have with us Leidson Rangel from the Receita Federal. Brazil has been busy with a lot of things of late, a lot of things. I mean, first you had the dividend issue, then you had the alignment of the transfer pricing rules on the OECD standards, which is now pretty much, yeah, I mean, not pretty much, it's actually done, except that, yeah, it would be effective from next year, although companies have an option to apply it from now. Then you had PEC 45, which is probably the most profound reform of Brazilian taxation in the last, generation at least. And now again, the dividend issue. But if I understand correctly, the Receita Federal has not been sleeping, and you've been working actually on the global minimum tax as well. So with this, please, I have to mention that this is a premiere in a sort, because the Receita Federal and the Brazilian government in general never until now addressed the issue of GMT, being busy with all the other issues that they've been dealing with. And so we're happy to have you with us for this first announcement considering Brazil's plans with Pillar 2 and the global minimum tax. Please. And you will be speaking in Portuguese, I have to mention, for the benefit of our audience. Please, go ahead.
Yes, thank you, Dali. Hi, Miranda, Alvaro, and John Peterson. Good morning, good afternoon, and good evening to all our audience. So first of all, I would like to thank ABDF for inviting me to participate in this prestigious Congress. It's an honor to be here, and in particular to be here with you. So as Dali mentioned, this is the first time that the Brazilian government talks about Pillar 2 implementation process in a panel dedicated to the topic. And for this reason, and also to avoid misunderstanding in the translation, I believe that my presentation will be better understood in Portuguese. So from now on, I will be speaking in Portuguese. Olá, boa noite a todos. Bom dia, boa tarde, boa noite, dependendo do horário de onde cada um esteja. Eu queria solicitar que fossem colocados os slides. Eu tenho um conjunto de slides. Se for possível, colocar o conjunto de slides. Bom, apesar do tópico do painel ser a implementação do Pilar 2 no Brasil, e como o John já mencionou, o Pilar 2 ser composto tanto pelas regras GLOBE quanto como pela STTR, eu quero focar a apresentação nas regras GLOBE e no QDMTT, que são os elementos que nesse momento são mais relevantes para o nosso contexto, né? Por favor, poderiam avançar o slide? Mais um clique, por favor. So, antes de mais nada, eu devo dizer que o Brasil, como todos sabem, ainda não adotou, não divulgou, não anunciou uma decisão política relativamente à implementação das regras GLOBE ou de um QDMTT. Conforme o Dali mencionou, nós temos uma agenda bastante lotada, né, Dali, nos últimos meses ou anos, com a implementação de outras medidas de ordem tributária. Portanto, até esse momento, até às 17 horas e 52 minutos do dia 15 de agosto, nós não anunciamos ainda se nós vamos implementar regras Globo e que o DMTT, quando e quais medidas nós iremos adotar. Mas, apesar dessa ausência de decisão, nós temos um conjunto de elementos e de dados e de tudo que vem acontecendo no panorama internacional, bem como de alguns elementos domésticos e da própria ordem de aplicação das regras Globo, como o John mencionou, que conseguem dar as diretrizes para aquilo que o Brasil deve fazer nos proximamente, né? Então, por favor, pode dar um clique. Nesses elementos, eu destaquei aqui 4 elementos. O primeiro deles é relativamente, e como o John já mencionou, a ordem de aplicação das regras. Se a organização puder dar um cliquezinho só para, por favor, na tela. Isso. Então, o primeiro elemento, ele é a ordem de aplicação das regras. Então, como o John mencionou na apresentação dele, o QDMTT, ele tem uma prioridade na ordem de aplicação das regras. Então, na situação em que a jurisdição se classifique como uma low-tax jurisdiction, ela consegue exercer a sua prioridade ou preferência na arrecadação do top-up tax, introduzindo um QDMTT, que é o Qualified Domestic Minimum Top-up Tax, ou Imposto Mínimo Doméstico Qualificado para os brasileiros que estão nos ouvindo em português. Portanto, esse é um elemento crucial na análise do cenário brasileiro, porque a depender da posição do Brasil na estrutura do grupo multinacional, o Brasil pode exercer a sua prioridade quando se situa numa posição em que as parent entities estão fora do Brasil mais fortemente, ou o Brasil pode não coletar o top-up tax que surge em outra jurisdição, quando o Brasil é a jurisdição de alguma parent que poderia aplicar IIR, por exemplo. Então, esse é um primeiro elemento, a ordem de aplicação das regras, combinada com outros elementos que eu mencionarei aqui, ela direciona e ela aponta para qual caminho que nós devemos seguir. Então, portanto, um primeiro ponto de vista eu tenho que separar a análise do Brasil em 2 situações. Primeiro, o Brasil enquanto jurisdição de UPIs, IPIs, POPs e outros parents que poderiam arrecadar top-up tax via IIR ou UTPA, e o Brasil enquanto jurisdição que dá origem ao top-up tax, que possui low tax constituent entities. Quando o Brasil está na posição de uma jurisdição que tem potencialmente a possibilidade de arrecadar top-up tax via IIR ou UTPR, esse meu potencial ele vai se concretizar em um maior ou menor grau conforme as jurisdições das minhas investidas tenham ou não adotado QDMTTs. Portanto, esse movimento que se vem se desenhando nas outras jurisdições de adoção de QDMTTs é um movimento importante para nós ponderarmos aqui para a nossa realidade. Por outro lado, quando o Brasil é a jurisdição da Constituent Entity que gera top-up tax, o movimento que eu tenho que verificar é se as jurisdições onde estão as parent entities implementaram regras Globo. Nessa situação, eu tenho o direito, né, ou a prioridade em recolher o tributo, e se eu não recolher, o tributo vai ser recolhido em algum lugar, né? Portanto, no contexto Globo, esse tributo que surge com o top-up tax, havendo massa crítica de implementação, ele vai ser recolhido em algum lugar. Então, não tem a possibilidade, havendo massa crítica de implementação, de o tributo não ser recolhido. Isso é um elemento, um primeiro elemento importante. O segundo elemento que eu gostaria de destacar, peço para dar mais um clique, diz respeito à presença de grupos multinacionais em escopo no Brasil. Então, nós buscamos os nossos dados de 2019, são dados pré-pandemia, para poder traçar uma fotografia da situação do Brasil. E esses dados, nós buscamos eles basicamente dos returns que as companhias entregam no Brasil relativamente à operação brasileira. E nós identificamos que em 2019, nós temos aproximadamente 2.880 grupos multinacionais estrangeiros, com UPI ou outras parents estabelecidas fora do Brasil, que atuam no Brasil. Esses grupos multinacionais, eles atuam no Brasil por meio de aproximadamente 6.600 constituent entities. E esses grupos multinacionais, eles estão estabelecidos em 80 jurisdições, cerca de 80 jurisdições. Então, essa fotografia, ela é relevante, porque ao observar o processo de implementação ao longo do globo, eu consigo perceber se um top-up tax surgido no Brasil será coletado fora ou não. E se eu devo ou não, nos dá a mensagem se nós deveremos ou não rapidamente implementar regras Globe ou QDMTT, nessa situação especificamente QDMTT. A outra fotografia que eu também tiro é quantos são os grupos multinacionais brasileiros com UPIs situadas no Brasil. Essa fotografia, ela nos mostra que nós temos 110 grupos multinacionais brasileiros, ou seja, grupos que estão atuando em outros países ao redor do mundo e que também estão atuando no Brasil, porque eles têm operação brasileira. E essa operação brasileira, na hipótese em que for subtributada, ela vai gerar top-up tax que pode ser recolhido em outra jurisdição via UTPR, por exemplo, né? Então, essas duas fotografias, elas são extremamente relevantes para nos direcionar para quais medidas é que nós deveremos adotar. Portanto, naquele primeiro cenário em que eu tenho 2.880 grupos multinacionais estrangeiros, se o Brasil ele tem a prioridade no exercício, no recolhimento do top-up tax. E se eu não recolho, invariavelmente o tributo vai para outra jurisdição. Mais um clique, por favor. O terceiro elemento é o que o John já mencionou, que o Dali mencionou agora há pouco a falar da União Europeia, que diz respeito à massa crítica de adoção das regras Globe. Então, o que nós temos hoje, conforme o Dali mencionou, é uma diretiva da União Europeia, com 27 Estados-membros, e os Estados-membros efetuando a transposição. Nós temos players importantes como Reino Unido, Japão, Canadá, Coreia do Sul. Portanto, hoje o que nós podemos dizer é que top-up tax surgido no Brasil, numa situação em que os grupos multinacionais são estrangeiros, nós já temos massa crítica para que esse tributo seja recolhido em outra jurisdição. O nosso retrato ele mostra que a União Europeia é um player importante, o Reino Unido é um player importante, o Japão é um player importante. Isso quando eu considero apenas UPI. Se eu olhar outras parents, o cenário ele é mais claro ainda, né? Ou seja, top-up tax surgido no Brasil no próximo ano, em 2024 já, ele possivelmente será recolhido em outra jurisdição se nós não adotarmos nenhuma medida de resposta. O quarto elemento, por favor, mais um clique, que eu gostaria de colocar aqui, são os incentivos fiscais. Porque se eu sei que a ordem de aplicação dá prioridade ao Brasil recolher via aqui o DMTT quando eu sou a jurisdição da constituinte entities subtributadas. Se eu sei que eu tenho grupos multinacionais dentro do escopo que atuam no Brasil, e se eu sei que o mundo já está adotando regras Globe de forma que se eu não exercer a prioridade, outros exercerão, o que eu preciso verificar é se eu estou em situação de subtributação. Se o Brasil apresentará montantes relevantes de top-up tax. Nesse cenário, o elemento que pode nos levar mais significativamente para essa situação são os nossos incentivos fiscais. Dali provavelmente deve saber disso, mas talvez a Miranda e o John não saibam. O Brasil tem uma alíquota de tributo sobre a renda e sobre o lucro de aproximadamente 34%. Então, à primeira vista, uma alíquota nominal de 34% poderia sinalizar que, olha, o potencial de surgir top-up tax ali é muito baixo. O problema é que quando as empresas brasileiras que atuam no Brasil, elas combinam o uso legitimamente dos variados incentivos fiscais e dos variados mecanismos que nós temos, esse leque de incentivos fiscais que nós temos no Brasil levam a situações de baixa tributação, em que, apesar de eu ter uma alíquota nominal elevada de 34%, eu tenho situações em que, situações relevantes em que a alíquota efetiva é inferior a 15%. Portanto, de tudo isso que eu falei, mais um clique, por favor, a conclusão imediata é que o Brasil necessitará implementar um Domestic Minimum Tax. E aí a pergunta, ou a pergunta-chave não é qual medida o Brasil precisará implementar, nem se o Brasil precisa implementar. Quando nós olhamos para o nosso catálogo de incentivos fiscais e toda essa realidade que eu desenhei aqui, a pergunta mais relevante é quando o Brasil irá implementar? Porque eu tenho top-up tax, se eu não exerço a minha prioridade, alguma outra jurisdição recolherá esse tributo. Portanto, a conclusão mais fácil de se chegar, obviamente, é que nós necessitamos de um Domestic Minimum Tax. Preciso implementar um IIR ou um UTPA? Essa avaliação é um pouco mais complexa, porque eu tenho que analisar a resposta, a implementação que as outras jurisdições estão fazendo, porque elas podem exercer a prioridade via QDMTT. E também os dados que nós temos não conseguem nos dar uma resposta tão precisa quanto a situação do Domestic Minimum Tax, né? Dito isso, o que eu posso dizer é que, apesar da decisão, mais um clique, por favor, apesar da decisão política ainda não ter sido tomada, tecnicamente, a Receita Federal, que é quem representa o Brasil no WP11, que vem acompanhando todas as discussões, possui uma proposta técnica desenhada que está 95% pronta para adoção de Full Globe, IIR, UTPA e QDMTT. Então, nós temos uma proposta pronta, desenhada, temos dialogado, obviamente, com o Ministério da Fazenda para deixar o ministro confortável das medidas, e essa proposta ela é plenamente adaptável. Portanto, se o ministro e o governo brasileiro decidirem, olha, nós vamos implementar só um DMT, nós fazemos os ajustes necessários para que seja encaminhado apenas o DMT. Se o governo brasileiro decidir que quer implementar Full Globe e o DMTT, a proposta também está pronta para enviar. Então, apesar dessa decisão política não ter sido tomada, tecnicamente a proposta está quase 100% pronta para que o Ministério da Fazenda e o governo brasileiro possam avaliar o melhor momento, né? Nós temos essa questão da agenda de reformas, o Ministério está ciente, o governo está ciente da possibilidade de que ano que vem já tenha tributo que possa ser arrecadado em outra jurisdição, portanto, nós temos uma medida pronta dependendo apenas dessa decisão política. Aqui eu queria abordar dois elementos, um que está na decisão, na proposta que nós estamos apresentando, e um outro que é uma avaliação que nós vamos precisar fazer em algum momento, talvez muito mais rapidamente. Nós já temos feito, confesso que nós já temos feito alguns estudos, mas o primeiro deles é o tributo mínimo doméstico. Próximo slide, por favor. Pode dar mais um clique. Dentro desse contexto Globe, nós temos algumas alternativas, e eu acredito que o Álvaro vai tocar em alguma delas ao falar sobre imposto mínimo doméstico. Mas nós temos a possibilidade de que as jurisdições optem por implementar tributos mínimos domésticos que não se qualifiquem como um QDMTT, e esse parece ser o caso de algumas jurisdições que atualmente já têm tributos mínimos domésticos e possivelmente não querem mudar em direção a um QDMTT, né? E eu tenho também a possibilidade de adotar um QDMTT, ou seja, elaborar um tributo mínimo doméstico que espelhe as regras Globe e que esteja desenhado para que os grupos multinacionais possam se enquadrar para fins de safe harbor. Então, o guidance que saiu recentemente, né, conforme vocês já citaram, possui mais orientações sobre o QDMTT e traz as características de um QDMTT safe harbor. Nesse sentido, a Receita Federal e o Brasil, de uma forma geral, atuou no WP11 e aqui eu preciso reconhecer o esforço do secretariado, na pessoa do John e dos demais delegados das outras jurisdições. Então, nós atuamos para que tanto o guidance do QDMTT quanto do QDMTT Safe Harbor, eles estivessem preparados, né, ou estivessem desenhados de forma que a realidade brasileira pudesse se encaixar nesses dois documentos. Aqui nós sabemos que, no cenário Globe, invariavelmente nós teremos uma elevação da carga tributária, porque de uma carga tributária geral, porque o top-up tax que hoje não é cobrado, será cobrado. Quando eu adoto um Domestic Minimum Tax, que é qualificado como um Qualified Domestic Minimum Top-up Tax, eu tendo a gerar uma carga tributária inferior àquela que seria gerada pela simples adoção de um DMT não qualificado. Isso especialmente, como o John mostrou na fórmula de cálculo do top-up tax, pela posição do QDMTT, que incide, que reflete ali no final do cálculo do top-up tax, e também pela presença dentro do QDMTT do SBI, Substance Based Income Exclusion. Então, quando eu falo de um DMT, ele é um covered tax, ele tem um impacto lá no início da fórmula do cálculo da alíquota efetiva, e quando eu falo no QDMTT, pelo fato de ele espelhar as regras Globe e pelo fato de ele poder estar adotando um SBI, ele tende a gerar uma carga tributária inferior a um DMT que não é qualificado. Relativamente ao QDMTT Safe Harbor, é importante dizer que com a implementação das regras Globe, e isso todo mundo sabe, não é nenhuma novidade, haverá uma carga administrativa adicional aos grupos multinacionais, porque agora eles precisarão implementar cálculos que não faziam antes. Com o QDMTT Safe Harbor, eu consigo reduzir essa carga administrativa relativamente aos cálculos da jurisdição que implementa o QDMTT e que atende os requisitos para ser um Safe Harbor, porque, sendo um Safe Harbor, o grupo multinacional não precisará calcular top-up tax daquela jurisdição, porque o top-up tax para fins de IIR e UTPA será considerado zero. Então, o Brasil trabalhou junto ao secretariado e junto aos demais delegados para que tanto o QDMTT Guidance quanto o QDMTT Safe Harbor pudessem estar adequados à realidade brasileira, e aqui eu destaco três aspectos, três características. A primeira é a possibilidade de introduzir um QDMTT adotando-se o padrão contábil local. Isso é extremamente relevante para a nossa realidade, e eu ouso dizer, relevante para a realidade dos países em desenvolvimento e das jurisdições com baixas capacidades, porque implementar um imposto essencialmente doméstico, adotando o gap da UPI, seria algo bastante desafiador. Então, essa já era uma característica do QDMTT e que foi incorporada como um possível, um elemento do accounting standard do QDMTT Safe Harbor. Então, um elemento extremamente importante para a realidade brasileira. Segundo elemento, a possibilidade de adotar a moeda local, também extremamente relevante, porque evita a necessidade de se fazer conversões e conversões. Então, essa possibilidade também é um elemento relevante. E no QDMTT Safe Harbor, uma abertura para que as entidades que, no contexto do Brasil, adotam o lucro presumido, possam se enquadrar no Safe Harbor. Nós sabemos que, na realidade brasileira, as entidades que apuram o imposto sobre a renda adotando o lucro presumido, elas são dispensadas para fins fiscais de manter contabilidade. Entretanto, a legislação comercial exige que ela mantenha contabilidade. Então, nós conseguimos convencer os demais delegados e o secretariado de que o caso brasileiro do lucro presumido também poderia se enquadrar ali, poderia ser um requisito a ser atendido dentro do que o DMTT Safe
Leidson,
Harbor.
can I intervene for
Yes, please.
Leidson?
Yes, please. Please
Yeah,
go
if
ahead.
I could intervene. Thank you very much. I think just one question I had in mind, basically. is whether you've already been thinking about, okay, what to do with your own CFC, because you have like CFC that applies very broadly. If you opt for an IIR or something, what are you going to do with your CFC?
Ok, Dali, Dali, isso é uma pergunta interessante, porque nós temos discutido internamente sobre se deveremos... Não, pode voltar, por favor. Se nós deveremos mudar ou não a nossa regra TBU, né? Dentro do contexto das regras Globo, nós consideramos que a nossa regra TBU, ela é, se não integralmente, talvez parcialmente uma CFC para o contexto de CFC Globe. É importante colocar isso. Há um conceito de CFC Globe. Isso é importante colocar, né? Nós não avançamos ainda nas discussões sobre reforma ou não da TBU. Não estamos convencidos nem de que ela deve ser reformada em direção a uma CFC tradicional, com a adoção de um IIR, nem de que ela deve ser mantida como está. Essa é uma avaliação dali que ainda não foi feita de maneira conclusiva. E nessa avaliação, nós entendemos também que é importante ver o que as jurisdições das investidas estão fazendo relativamente ao Globe, porque a nossa CFC, como nós temos uma alíquota elevada, há uma arrecadação que também deve ser considerada. Obviamente, isso não é o elemento principal, mas é um dos elementos a ser considerado, né? Então, respondendo objetivamente, nós não temos uma resposta conclusiva ainda sobre o que fazer com a regra, com a nossa TBU. Ok? Ainda nesse slide, um último elemento que eu acho que
no, definitely. I think a lot of the audience in Brazil are probably shocked about what they're waiting for them, with addition to the PEC 45 and everything and so. And I have the feeling that in Brazil, really a lot of the professionals didn't see the global minimum tax coming, but thank you for actually confirming that it is actually coming. And so they really need to prepare for it. Well, thank you so much. With your permission,
Dali,
yes.
Please, may I just conclude this slide?
Yeah, sure. Please go ahead.
I have another one, but I would like to conclude this one, okay?
Yeah. Sure.
Ok, só porque esse último elemento, esse último bullet é realmente importante por conta de uma questão que o John mencionou, que é o peer review process. O processo legislativo do QDMPT, ele tende a ser um processo legislativo diferente de tudo aquilo que o Brasil já tem experimentado ao longo dos últimos anos. John, Miranda, Álvaro e Dali, no Brasil nós temos uma tradição, uma máxima de que nenhum projeto sai do Congresso Nacional como ele entrou. O Congresso Nacional sempre quer deixar a sua impressão digital, a sua marca no projeto. E quando nós estamos falando de uma regra que deve ser qualificada para que produza os efeitos, a mensagem que nós passamos aqui é que é uma regra que não pode sofrer muitos ajustes do Congresso Nacional. Portanto, vai ser um processo legislativo um pouco diferente, né? Não há margem para alterações na proposta de legislação de forma a ajustar esse ou aquele aspecto, né? Porque, ao fim e ao cabo, nós podemos estar prejudicando a qualificação da regra. Obrigado, Dali.
Thank you so much, Leidson. Thank you. And I turn to Miranda. Miranda, I'm really sorry. I feel so bad to have waken you up, at 5 o'clock or something in the morning and have kept you waiting. But we cannot really miss you. You're covering 2/3 of humanity. You're going to talk to us about Asia Pacific. Please, the floor is.
Thank you. Thank you very much. It's very interesting. If we could perhaps open my slides. I have a couple, but they are just diagrams, very quick. Greetings from Australia. The sun has risen now. It's not dark anymore in Melbourne. So that's very nice. It's very interesting to hear of the developments in Brazil. because as you said, Dali, in the Asia Pacific region, we have some sleeping giants and we do not know yet what is happening. So is it possible to share the slides, or would
I think actually John knows, but he's not going to tell us.
He may know. That I would be very interested to learn if he has any inside information there. I'm just checking. Are you going to be sharing my slides, or should I do this? No.
You're on mute, Dali, I think.
Oh, can somebody please share the slides of Professor Miranda Stewart? Thank you.
Actually, perhaps I can do it. This is my own.
No, I
does this
think,
work?
yeah.
Okay, so just very briefly, but we don't need to go through this. I've drawn this KPMG, some of the firms, they have these nice summaries. Of course, people know the timeline. We already heard this from John. So just a reminder of the timeline here. But taking you to Asia Pacific, so of course, the many advisory firms are producing these summary reports. I believe Brazil IFA is also doing a heat map. So this is one that was just released in August by one of the firms. It shows you the progress for state of play for Pillar 2 in the Asia Pacific region. And it identifies, as you can see, a number of countries, Australia and New Zealand in the south, and then a number of countries in South and East Asia. Of course, OECD member states, Japan and South Korea, have been very early adopters of the 2 pillars. And certainly Pillar 2, South Korea has already legislated to commence at the commencement time, expected commencement time. Singapore is also very active. So it is quite interesting that in the Asia Pacific, we have, of course, many very large countries, but we have, as in large populations in particular, but some small and lower tax jurisdictions. Hong Kong and Singapore are very well known, but in the Pacific, there are a lot of more traditional tax havens, perhaps, or zero or low tax jurisdictions. Cook Islands, Vanuatu are 2 examples. There is no news yet about what these jurisdictions will do. But Singapore and Hong Kong have been very active as well. Singapore has engaged from the beginning, even though it's probably not their policy preference to go down the minimum tax route. Nonetheless, they have signed up. So what is interesting, though, is that this looks like quite a lot of countries, quite a lot of progress, but there is rather a lot missing here. So in particular, of course, what about these big players? China, People's Republic, and India. They have not yet publicly announced positions on Pillar 2, although they have both been, of course, engaged in the process, inclusive framework process. It is interesting to speculate about their position. And if anyone has any further information, I would be keen to hear it. But of course, China, with its economy, is perhaps a little more similar to the United States. It's a very big exporting economy, lots of intellectual property, also a very big market jurisdiction, of course, with many wealthy consumers. And so although China sometimes positions itself as a developing country, right, of course, has a very large population, not everybody is wealthy, they have a lot of internal challenges. From an international tax perspective, China is, I would say, more like the United States. And so for them, it is easy to just wait and see, I would say. India, of course, is rather different, right? And India has been of course, engaged in the inclusive framework, but also a leader in other ways, right? Moving ahead with internal unilateral measures, digital services levy, definition of significant economic presence, permanent establishment, extension in India, development of anti-abuse rules, extension of anti-abuse rules domestically. So it would seem that India would like, you would think, to adopt the effective minimum tax. They have also been changing, recalibrating their relationship with Mauritius in particular, which is an important treaty hub for investment in and out of India. But we don't know for sure what they are going to do. But the other point here, of course, is that there are many other countries in Southeast Asia and South Asia.
Miranda, if I could just for a minute interject in India.
Yeah.
What my understanding, probably John can confirm that, is that actually they're very advanced in drafts for the global minimum tax. It was very interesting to see their position on the STTR, that they agreed to release it, although they had reservations. That's actually what they noted in the thing. And now, with respect to this, with respect to China, it's just speculation. But the fact that Hong Kong has actually will be adopting, people see that as maybe an indication of where China as well is going. And
yeah, that's it. That's it. I'm not sure. I mean, that's an interesting observation. Of course, Hong Kong, in many ways, China is more engaged in Hong Kong, even though a special administrative region and the basic law and separate administration. I think they sometimes like to have Hong Kong run its own, some of its own economic and tax aspects, which are very different from mainland China, the rest of Hong Kong's tax system. So anyway, I'm not sure about that, but that's an interesting thought. Sorry, Dalisha, did you want to make some? I have just a couple more.
No, please go ahead. Just on that list, Pakistan, I think, is an opt-out, right? From the whole.
Perhaps you're right.
Isn't that so, John?
They did not sign up to your rights to the original IF October statement. That's correct. I don't quite know where they were in relation to the most recent.
I think they with Sri Lanka,
but I think
Sri Lanka, right. Nigeria, and
but certainly on the initial,
exactly.
on the October IF statement of last year, they didn't sign up. That's correct.
Yeah. So, you know, an international tax cooperation in Asian, Southeast Asian region is not that well developed. I mean, there are many bilateral relations, but there is not such a strong history of regional engagement as in Latin. There is no kind of general forum like the African Forum. You know, there is not that much of a common position between countries in Asia. So just to go on, a couple of interesting comments. I would have liked to give you an example from Australia, but we do not have any draft legislation yet. So I just thought I would make a couple of general comments and raise a few little issues about implementation, right? If we are going to implement. So New Zealand has now has a bill in the Parliament. I think this is John's country of origin. He's been in Paris for a long time. You know, New Zealand and Australia have been closely involved in the working parties and in the process. And it's interesting to contrast the approach that is taken with New Zealand compared, for example, to the UK. And then, of course, you have, as you said, Dali, in Europe, you have the directive. So in New Zealand, they are incorporating into the legislation by reference. That is, they are not rewriting all the rules in the legislation. They are referring to the Globe model rules. So I just gave you a little example. Of course, they are making some modifications, but they have this components of the applied Globe rule the components are the rules set out in articles of the Global Anti-Base Erosion Model Rules, right? So we are directly implementing these articles from the model rules, and then we modify them a little bit, right, to fit the domestic scenario. And they list where these modifications are going to be in the New Zealand law. So that's quite interesting. In Australia, to be honest, no matter how much I talk to Treasury people, I don't have information about our approach. It seems like this would be a good idea, but we have a history of enacting directly all of our own rules, writing them in detail, for example, the hybrid rules for Action 2. So we don't know yet. We are calling the two taxes a global minimum tax and domestic minimum tax. We do know that this is the kind of language we are using. And certainly we are not proposing, I would say, to abolish the CFC rules. The other thing that I think is also,
Miranda, I'm
sorry,
sorry,
yes.
if I can interject for a minute. So
Yeah.
for Australia, basically, you have this, you've been really, really busy lately with this integrity rule, et cetera. And one of the integrity rules, the intangibles integrity rule, is that like some sort of UTPR?
Yes, so
Some sort of...
Yeah, it's we want to have all the rules all the time, right? So I'm just other BEPS, I just jump forward here. So other anti-abuse rules, of course, we have a lot of anti-abuse rules from the BEPS 1, right? The first element, we already had a general anti-avoidance rule in our statute, but we have this proposal currently in the Parliament that it has been deferred a little, but to deny a deduction for payments in relation to intangibles that go offshore, so base eroding payments, when they are going to a low tax jurisdiction. This is a very, very brief summary. And there has been a lot of uncertainty. For example, this is a very broad concept, intangible assets. It will apply potentially even if the intangible is embedded in goods, like a brand name, trademark, not just copyright and intellectual property. So yes, there is a lot of attention happening. Just jump back a little to these domestic unilateral anti-abuse rules, which we continue, but we are also going to do Pillar 2. And there is a question about the overlap of these rules. John, I think the OECD has started to talk about decluttering the rules. I don't know if it's worth commenting on that.
Yeah, I think that's that we I guess both expect and hope that there would be once we have a sort of a stable framework for assessing what counts as low tax, that at least to the extent that we have rules that are triggered by low tax outcomes in other jurisdictions, then countries could look at the need for those rules, because our experience has always been that trying to do those kind of rules unilaterally is very challenging. They tend to be both over-inclusive and under-inclusive in their scope. They're difficult to administer and often become a source of further tax planning at the margins. So we are strong believers that once you have a jurisdictional effective tax rate of 15%, then maybe there isn't such a need for those kind of rules, and that would sort of be certainly one of the first places that we would look to in this decluttering exercise that we would hope countries might want to explore following the introduction of the GLOBE rules.
So just a comment on that, this intangibles denial of deduction, this intangibles base erosion rule that is proposed in Australia, it is actually supposed to have an effective start date now, essentially, but it has not yet been legislated. This happens occasionally in Australia, the legislation comes later. But yet if the Pillar 2 has an effective start date, in 2024, it may have very little operation if it is true that these are really an overlap, and we don't know. So I guess it's an example of a situation where countries are doing unilateral action, unilateral anti-abuse, potentially overlapping with the BEPS pillars. Dali, you will tell me if we need to run out of time, but I just thought one other interesting thing.
Sure.
Sorry.
No, please go ahead. I just have one question, and I would like to leave some time also.
Of course.
We have 15 minutes extra, because I really would like to hear Alvaro later.
Oh, yes.
But please go ahead, and then I have a question for you.
Yeah, so look, no, just very briefly, I think this is also a rather interesting question that we are all going to have to deal with, as you say, Dali and Leidson, the pillar 2 is coming. How do we interpret these rules? And the New Zealand draft has a proposal about interpretation. So the global anti-base erosion model rules are treated as applying consistently with the most recent commentary published by the OECD before the start of the fiscal year of the relevant time for the rule. So this is ambulatory, right? That the interpretation of the domestic Pillar 2 rule, the GLOBE, will follow changes in the model over time, in the model rules and the model commentary. And I think this is quite important question, and many countries may not have a specific rule about this when they enact.
Well, there are quite a few. We have quite a bit of case law in Europe. I think lately, just this year, the Spanish Supreme Court said that you cannot apply ambulatory interpretation. So yeah.
Okay, so it's kind of the opposite, right? To this suggestion.
Yeah.
Well, this is a challenge when you are setting up a new international tax system, right? Which is really what we are doing.
I think also the Italian Supreme Court, by the way, same position.
Yeah, interesting.
But okay.
Yeah. So look, I won't go through all of these. We heard some of this already from
right. Thank you.
the
Thank
others.
you so
These
much.
are the issues. So yeah, that is all.
Just one question, Miranda, since we're talking about Asia Pacific. I'm not sure John would like to comment on this, but we have the example of Vietnam, which is very interesting. So what they did actually is they made the math, think like Brazil did, and they came up with something like 200, out of memory, 237 local constituent entities in Vietnam, with investment capital above $100 million. And out of those, all of them are below 15% TTR. So they calculated, okay, how much top-up tax, if we have DMTT, are we going to collect? And then that would go into a fund. And that fund, I don't want to call it compensation, but I don't want to qualify it, but basically at the discretion of the Prime Minister, some or all of these constituent entities would get some money back from that fund. I don't want to qualify it, because if I qualify it as an actual refund of the QDMTT, then John is going to say, it's not qualified, forget it, right? But what do you think of it? I mean, either Miranda or John.
Perhaps I'll come in here. So we have been in discussions, and we have been working with the Vietnamese government and in the development of their legislation, and they do understand the constraints that operate in this space. And I think you're right, one sense, Dali, to be careful about how we describe this. I think we need to recognize that there are some countries that will raise money through the imposition of a minimum tax, and then they will want to know how, and then they want to think about how they want to spend it. And it's within every government's sovereign capacity to decide how it spends its money. Now, there are constraints within the operation of the GLOBE rules, of course, that prevent you from providing benefits in connection with the imposition of the tax. So ultimately, if you had a design which was that the money was going to somehow be refunded to those who were paying it, that just wouldn't work from a global perspective, and we have a peer review process that will ensure that that is the case. At the same time, I think we do need to confront relatively squarely the fact that subsidies of any kind of description are still clearly an acceptable way of a government spending money. And that's recognised in the rules.
So basically, you would be looking at an actual causality between the top-up tax and the amount of the subsidy being given to a constituent entity.
Yeah, the strength of the system, I think, here is that we do have a peer review process, and we are building, an administrative framework that is designed to protect the integrity of these rules. So ultimately, these questions, I think, come back to the Working Party itself through the Council of the Secretariat to look at particular instances of how these rules are being developed and applied in particular cases, with the idea of diagnosing if there are problems and coming up with sensible solutions to address them. Yeah.
Clear. Thank you so much. Now with this, we move to Alvaro. Alvaro, thank you for being so patient with us. LATAM. LATAM less Brazil. It is going to be very, very small if you would exclude Brazil, but please, the floor is yours.
Oh yes, Brazil is a subcontinent here. So thank you, Dali, for the coordination. I want to thank also to ABDF board for the invitation, and it's always a pleasure to share a panel with these prestigious colleagues and attendees from Brazil and across Latin America. So I know we are run of time, so I will try to go fast in this part. I think we have no sleepy giants at all, but maybe sleepy beauties over there in the country. In Latin America, we are always...
There are a lot of beauties in Latin America, yeah, definitely.
Of course. And Brazil was one of them. No? So I think, in Latin America, we expect what is happening, to see what is happening in Argentina, in Mexico, or Chile, Brazil. But when you have nothing about them, you have to be concerned. You have to be sleeping more. So what I'm going to present here is I will be more focused on inbound perspective of LATAM, because we can see both sides, but this presentation is just inbound for the countries, and I will also address the corresponding limitations of the source principle caused by ETR calculation and the QDMTT. And I will also speak very shortly about the feasibility of applying the STTR in the LATAM Treaty Network, and I will finish making a short reference to the outcomes of the famous first Latin American and Caribbean Ministerial Summit that was held in Cartagena a couple of weeks ago. As it was mentioned earlier, the global rules will put in place an effective global minimum tax for large M&As, and this is perceived by the OECD documents as an opportunity. It's an opportunity for developing countries to implement reforms of the income tax systems. But however, I think, I have to say that the realities are quite different, because I think Latin countries are more concerned and grateful for the opportunity to make changes. In my opinion, it can be clearly seen by looking at the number of Latin American countries actually engaged to implement Pillar 2 in the following months. In fact, we can see Colombia. This is the only OECD country that has shown a clear position. I mean, it's not only a discursive position, it's indeed a clear position, because they are reforming, the Colombia reform, the last year, its tax law to implement a domestic minimum tax of 50%. That is in Spanish, tasa mínima de tributación, or TMT. However, it was made, I think, without being sure that it will fulfill all the requirements to be considered by the OECD as a qualified domestic top-up tax. I think this is because we are now in understanding better the numbers and the administrative issues. So it was last year project and legislation. So in my opinion, in this case is that Colombia overreacted to the decision. The decision was made under certain pressure without having clear information about the real impact on the revenue and domestic tax incentive at stake. That is why Colombia now, we can see Colombia is alone and is still looking around for additional solutions and support for Latin America's peers, since Colombia was the host of the ministerial tax summit I was referring early. Furthermore, I can see that Colombia is the only Andean Community Treaty member that is engaged in Pillar 2, and it's not clear if the consequences triggered in relation to the exemption method have been totally considered at that time. The other countries, Mexico, the OECD is big player in LATAM, which traditionally applies all the OECD recommendation in early stages, as you know, and is being more Mexico is being more cautious because at this time there is no specific legislative measures nor projects being discussed, at least in public. However, it is expected that Mexico will continue to be aligned with the OECD. I think it was a statement that they was issued in within the ministerial summit also, that they will be aligned with the OECD, but I think it will be in a very different timeline. You know what happened, for instance, with the MLI. The process took longer than expected, no? Just to have the MLI effective in Mexico. So what we can learn from Mexico is that they are very concerned about the tax incentives affected by global rules, especially in areas like Maquila and others incentives recently approved. So of course, as an involved country, the concern is the same of many Latin American countries, since it may maybe feel pressure to adopt the QDMTT to preserve its power rights and also to avoid losing revenue in favor of the developed countries. We have to speak a little bit about Chile, and Chile is the other important OECD active member, but Chile has just remained silent and at this time, and maybe dealing with first with other issues like maybe political issues. However, it is expected that Chile will be in line with OECD later, especially if Mexico moves forward between or within the following months. Argentina is, although you know Argentina is not OECD country, but he is G20 member and has no issued official communications regarding the adoption of Pillar 2 at all. And I think Argentina is also at this time maybe facing political issues or calculations. On the other side, we have Bolivia and Ecuador. They are actually the opposite side of the moon. I mean, I'm not sure if they are in the dark side or the clear side. It is up to you where they are, but they are not part of or members of the inclusive framework. So you know, the OECD, G20, and the other side, countries that are not part at all the inclusive framework. And both countries are currently having different priorities, mostly governed by difficult of economic and political scenario. So there is not in the map speaking about Pillar 2. So from the Andean community perspective, we can see one member engaged in Pillar 2, which is Colombia. Two countries are not showing interest in Pillar 2, and Peru are part of this third group of Latin countries that are waiting for more developments in this matter and maybe expecting additional solution for other platforms like UN or ministerial platform.
Alvaro,
Yes.
is it safe to assume that for all these middle countries is going to be QDMTT?
Yes, I think so. I think so. That's the point I'm going to address now, because the MTT and the ETR and the STTR are the three main interests in Latin America, and the complementary. That's at least that's how I try to make difference between the original QD-MTT and the complementary that is allowing being more attractive the option of developing countries, since they have a strong incentive to raise taxes to ensure they will capture the revenue. However, it actually means that the Latin American countries feel that they are forced to reform the systems by reducing the tax incentives. And in fact, it may reduce the effectiveness of many tax incentives in attracting foreign direct investments. But in any case, Latin countries may decide between two options. I think just is to raise the corporate income tax rate, as the case of Bermuda that we were talking about, or maybe introducing a new QD-MTT. Of course, my opinion would be to take the second, because it's a better option in any case. It's more simple, operational, and you are not going to distort the entire system. So regarding the substitute tax rule, I think Latin countries are going to implement the STTR in October 2023, or bilaterally, maybe amending the tax treaties to include this clause. And I think it will be an acceptable mechanism, because in all of our countries are withholding taxes applied as a very important part of the system. And I think applying this or allowing to apply the withholding tax in source countries in cases income is subject to tax below a minimum rate of 9% in residence.
And if I may say, as importantly as well, to cover the income which otherwise they would not be able to impose withholding tax on under the current at least OECD model. Let's say, for example, leasing income or insurance. I mean, there are certain types of service fees, for example, right?
Yes.
They are able to levy some tax on that.
Yes, maybe it's it makes more interesting when we are not talking about just interest or royalties only, but also services. I think it will be more attractive. And the ETR mechanism has been argued that it is damaging the source taxation and sovereignty of Latin countries. It's always a topic that we can see in all the forums speaking in Latin America about the Pillar 2, and especially because it may reduce the application of withholding taxes. In addition, it imply a possible renunciation of source country, more because it comes that if you cut the possibility of granting tax incentives and preserve tax-sparing clauses, for example, it would be seem that the Latin American countries are not willing to do, especially with tax-sparing clauses. So we have to see more developments about it. And regarding the first Latin American and Caribbean Ministerial Tax Summit, I think we were expecting more about that, but it was held in Cartagena 3 weeks ago, and they are calling for inclusive, sustainable, and equitable global tax order. And they were.
There will be a panel actually which will deal with that. I think with Thomas Balquinate with Marcio Verdi from
Okay,
Siga,
great.
etc.
Really good. Yeah. So the question to speak just about the joint declaration in technical terms, it is important to be that digitally to see that digital economy in that summit. It is one of the important topics for the ministers that were present there, and countries do not feel that maybe that's what say that it's important to generate the more benefits or to get unified voice in Latin America. And the question there is, this platform is just a forum for exchanging best practices, or it will serve as a cohesive voice for the region, for negotiations and discussions with at OECD and UN level? No? That's the question there. So this will be all. Dali, thank you.
Thanks, Alvaro. With this, well, first of all, I would like to thank ABDF for this opportunity. I would like to thank my and your friends in the organizing committee, Heleno Torres, Gustavo Vigagao, Marcos Catao, Andrea Oliveira, and of course, the two engines actually of the entire Congress, Dani Vigagao and Yandara, who have been really, really helpful in organizing all of this, plus the entire organizing committee. And I wish we had more time because there are quite a lot of issues. It's been a delight to have you on this panel. So I would like to thank you individually for your input. Again, apologize for the very early hour, the very late hours, getting really late for John now. John, I don't want to intervene really too much, but I think that you owe the kids tomorrow an ice cream for tonight.
I think every day is ice cream day at the moment, Dali. So maybe
Then make a double.
Yeah, exactly, something like that. Yes. Some Shanti or something like that on top. Exactly.
Exactly. Okay. Well, Leidson, thank you so much for being with us. It's been really a delight, and I think that the audience benefited a lot from learning what you are preparing for them. Miranda, thank you for your participation. It's been a delight to have you on. Alvaro, like always, hope to see you soon. Thank you all, and maybe on another occasion. Thanks.
Thank you, Dali.
Thank you.
you.
All right.
See you.
Bye.